In this video, we will discuss the depreciation of plant assets and look at two methods that can be used to calculate depreciation. Let's start with a definition of depreciation. Depreciation is defined as the allocation of a plant asset to the time periods benefited. Plant assets will be used for more than a year. As a result, when they are purchased, they are not expensed immediately. Instead, they are recorded as assets and expensed over the time periods that they will be used. If you will remember, land is not depreciated. This is because land is considered to have an indefinite life. However, land improvements, building, and equipment will be depreciated. In recording depreciation, we make the following entry. We will debit depreciation expense. This is a cost reported on the income statement. This cost reports the use of the asset during the time period. At the same time, we will credit the account accumulated depreciation. Let's look at this account in more detail. Accumulated depreciation is a contra asset account. It is opposite of the asset account that it relates to. Each asset will have its own accumulated depreciation account. Accumulated depreciation increases on the credit side, decreases on the debit side, and has a normal credit balance. Accumulated depreciation will reduce the book value of the asset on the balance sheet. Book value has nothing to do with resale value. In calculating depreciation, we allocate the cost of the asset. We are not attempting to determine the resale value of the asset at the end of the year. Remember, depreciation is a cost allocation technique. To illustrate book value, I have prepared an example. In this example, we have equipment that costs $20,000. At this point, our accumulated depreciation on the asset is $5,000. Accumulated depreciation is reported on the balance sheet and will get larger each year. In this example, the book value of our asset is $15,000. In calculating total assets, the $15,000 will be used, not the $20,000 cost. In calculating depreciation, we need to know three items. The first item is the asset's recorded cost. This is the purchase price of the asset plus any costs incurred in getting the asset ready for its intended use. The calculation of the recorded cost of the asset was discussed in a separate video. We will also need to know the asset's salvage value. Salvage value is also referred to as residual or disposal value. It is the estimate of what you will receive for the asset when you are done using it. For some assets, it is appropriate to have a salvage value of 0. This would be in the case of computers or cell phones. Finally, the last thing we need to know is the asset's useful life. This is an estimate of how long we think we will use the asset. Depreciation is an estimate. The only thing that we know for sure is the asset's recorded cost. Salvage value and useful life are both estimated in calculating depreciation. In accounting, we want to match the expense of using the asset with the time periods that it benefits. As a result, our best guess is an estimate. There are two methods of calculating depreciation that we will discuss. The first method is the straight line method. The second method is the declining balance method. The straight line method is the easier of the two methods. Under both of these methods, we will recognize the same amount of depreciation expense over the life of the asset. However, the amount of depreciation calculated each year will be different. In discussing depreciation, we will look at calculating depreciation for book purposes only. The calculation of depreciation for tax purposes is different. Let's start with the straight line method. Under the straight line method, the depreciation expense recognized each year is the same. Once you calculate depreciation, you will record the same amount every year of the asset's useful life. In calculating annual depreciation, we will take the cost of the asset and subtract its salvage value and divide that by the years of useful life. Let's look at an example of calculating straight line depreciation. In this example, Ace Company purchases equipment for $100,000 with an estimated salvage value of $10,000 and a 4-year useful life. What is the annual depreciation expense using the straight-line method? In this case, the annual depreciation expense is $22,500. This was calculated by taking the cost of the asset and subtracting its salvage value. This amount was then divided by the asset's useful life. In this case, $22,500 will be recorded as depreciation expense each year for 4 years. Before we go any further, let's talk about the concept of depreciable cost. Depreciable cost is the maximum amount of depreciation that you will recognize on the asset. Depreciable cost is calculated as cost minus salvage value. In this case, the asset's depreciable cost will be $90,000, the $100,000 cost less the $10,000 salvage value. Let's look at what the book value of this asset will be at the end of year 4. In this case, we start with the cost was $100,000 and subtract the accumulated depreciation. Since I will recognize $22,500 as depreciation expense each year for 4 years, at the end of year 4, I will have recognized $90,000 of accumulated depreciation. You will notice this is equal to the asset's depreciable cost. This again is the maximum amount of depreciation that I can recognize on the asset. At the end of year 4 in this example, the book value of the asset will be $10,000. This is equal to the asset's salvage value. If we use the asset for more than 4 years, we will not record any more depreciation on the asset. We do not want to depreciate the asset below its salvage value. Let's now talk about declining balance depreciation. Declining balance depreciation is an accelerated method. What this means is we record more depreciation in the early years of the asset's life than in the later years. In calculating annual depreciation under this method, we take the book value of the asset at the beginning of the year and multiply it by the declining balance rate. If you will notice, salvage value is not used in this calculation. Book value is equal to the cost of the asset less its accumulated depreciation. As a result, in the first year of the asset's life, the book value at the beginning of the year is equal to the asset's cost. Under this method, salvage value is ignored until the last year of the asset's life. In calculating the declining balance rate, we take 100% and divide it by the years of useful life. This amount is then doubled by multiplying it by 2. Let's look at the same example that we looked at previously, but this time let's calculate depreciation using the declining balance method. You will notice that the annual depreciation expense under this method will be different than the straight line method. This is because a different formula is used. However, the same amount of depreciation will be recognized over the asset's life. This is the asset's depreciable cost. In illustrating this method, I have set up an Excel spreadsheet. The items in blue are my headings for each column. If you will set up this table, it will make it easier to calculate depreciation under this method. My first column in the table is the year. This is the year of the asset's useful life. The second column is the book value at the beginning of the year. This is then multiplied by the declining balance rate in calculating the annual depreciation expense. Annual depreciation expense is the amount that will be reported on the income statement each year. The next column is the accumulated depreciation. This is the amount that will be reported on the balance sheet. The final column is the book value at the end of the year. This is calculated as the cost of the asset less the asset's accumulated depreciation for the year. This amount is needed so that I can calculate the next year of depreciation. On the balance sheet, the ending balance for one accounting period becomes the beginning balance for the next accounting period. Let's look at the calculation of depreciation for the first year of this asset's useful life. In this case, the book value at the beginning of year 1 is $100,000. This is equal to the asset's cost. Remember, under the declining balance method, we ignore salvage value in our annual depreciation calculation. This is ignored until the last year of the asset's life. In calculating depreciation for the first year, the cost is multiplied by the declining balance rate. This results in an annual depreciation expense of $50,000 for year one. The accumulated depreciation at the end of the year is then $50,000. This is equal to the depreciation expense that has been recognized this year. Finally, the book value at the end of the year is also $50,000. This is the cost of the asset, $100,000, less the asset's accumulated depreciation at the end of year one. Don't assume that in year one, the annual depreciation, accumulated depreciation, and book value will all be equal. What is true is that the annual depreciation expense and the accumulated depreciation expense will be equal. In this example, the three amounts are equal because the declining balance rate is 50%. In year two, we calculate depreciation by taking the book value at the beginning of the year again. This is now $50,000. This is equal to the book value at the end of year one. The $50,000 book value is then multiplied by the 50% declining balance rate. This results in annual depreciation expense in year two of $25,000. The accumulated depreciation at the end of year two then becomes $75,000. This amount can be calculated by taking the accumulated depreciation at the end of year one, $50,000, and adding the depreciation expense for year two, $25,000. It could also be calculated by totaling the annual depreciation expense through year two. Using either calculation, you will get the same answer, $75,000. At the end of year two, the book value of the asset is $25,000. This is the cost of the asset, $100,000, less the accumulated depreciation at the end of year two, which is $75,000. Depreciation for year three is calculated in the same manner. You will notice that I have year four in red. This is because I have calculated the depreciation incorrectly. I have done this so that you can more easily see the correct calculation of depreciation when it is performed. In year four, we will start with the book value at the beginning of the year. This is $12,500. If we multiply this by 50%, this will result in an annual depreciation expense of $6,250. This is too much depreciation. You will notice that this will result in accumulated depreciation at the end of year four of $93,750. This exceeds the asset's depreciable cost. You will also notice that the book value at the end of the year using this calculation is $6,250. This is less than the asset's salvage value. Remember, we do not depreciate the asset below its salvage value, even though salvage value is just an estimate. Since this calculation for year four is incorrect, let me now illustrate the correct way to calculate depreciation in year four. In year four, we will start with the asset's book value, but instead of multiplying it by the declining balance rate, we will calculate it based on the asset's salvage value. If you will remember, under the declining balance method, salvage value is ignored until the last year of the asset's life. As a result, depreciation will be calculated by taking the book value of the asset at the beginning of the year, $12,500, and subtracting the $10,000 salvage value. This will result in annual depreciation expense of $2,500 in year four. My accumulated depreciation will then be $90,000. The book value at the end of year four will then be $10,000. This is equal to the asset's salvage value. Let's review depreciation. Depreciation is the allocation of a plant asset to the time periods benefited. In calculating depreciation, we looked at two methods. The first method was the straight line method. Under this method, the same amount of depreciation expense is recognized each year. The next method is the declining balance method. This is an accelerated method. Under this method, depreciation was calculated based on the book value of the asset at the beginning of each year.